What if I told you that the smart Roth conversion strategy that your advisor recommended could cost you six figures? Right now, millions of retirees are being told the same thing. Convert as much as possible while tax rates are historically low. Pay your taxes now, not later. It's a no brainer. Except, it's not. I run the numbers on Roth conversions every single week, and here's what I've found. For about a third of retirees that I've worked with, these conversions are either neutral or, in some cases, actively harmful. They're paying tens of thousands, sometimes hundreds of thousands of dollars in taxes today that they'll never likely recoup. And the financial planning industry has turned Roth conversions into a religion. But religion requires faith, and your retirement requires math. I'm John Norberg, financial planner and owner of Norberg Wealth Management, and in today's video, I'm going to show you 5 specific scenarios where Roth conversions do not make sense. And the third one could be the single most expensive mistake you make, so stay with me. Because if you're considering a Roth conversion this year or in the future, or if you've already started doing them perhaps, then this video might save you six figures. So with that introduction, allow me to welcome you to this latest edition of the Financial Prof series. Alright, so the first reason to stay away from Roth conversions is if you're already in a low tax bracket and likely to stay there. Here's the math everyone forgets. Roth conversions only make sense if you're paying taxes at a lower rate now than you will in the future. But what if you're not? Let's say you retired with a pension of $45,000 and Social Security of $28,000. Total income, $73,000. After the standard deduction, you're probably in the 12% federal tax bracket for the part of your income and just into the 22% tax bracket as a single filer. Let's say your friend tells you that you need to do Roth conversions before tax rates go up. So, okay, let's go ahead and run the numbers. Even if you do nothing and just take your required minimum distributions or RMDs starting at 73, you'll stay in the 12% and 22% brackets for most of retirement. Your RMDs will only be about $30,000 annually on an $800,000 traditional IRA. But if you convert now, you'd have to convert at 22% or even 24% to make any real meaningful dent in that traditional IRA. You'd potentially be paying double the tax rate to avoid future taxes that you were never going to pay at those higher rates anyway. That's not tax planning. I call that voluntarily paying extra taxes, which I have yet to meet the individual who likes doing so. Here's the reality. If you're retired or semi-retired with modest income, you're probably already in one of the lowest tax brackets that you're likely to see. Converting from 12% to avoid future 12% taxes makes no sense. You're just prepaying taxes for no tangible benefit. And if you're in the 10% or 12% bracket, the chances that in the future you'll be in a higher bracket are fairly slim, unless you have massive IRA balances or significant other income sources. Of course, if tax rates do go up in the future, this could change this scenario. But there's a scenario that's even worse than converting from a low bracket, which brings us to the second reason on our list. So, what is that? Reason number 2, you have significant charitable intentions. That's right, we're giving some of this money away, right? So here's the thing. Reason number 2 being significant charitable intentions is you plan to leave a not insignificant portion of your IRA to charity. So what do I mean by not insignificant? Well, if I'll just say 5% or more of that is going to charity, this is something you should be perking up your ears at. You see, if you're charitably inclined and planning to leave IRA assets to a church, a nonprofit, or a charitable foundation in any meaningful way, Roth conversions might be about the worst thing you can do for your tax picture. And here's why. Because as you probably already know, charities do not pay taxes here in the United States. Ever. When a charity inherits your traditional IRA, they take the full amount tax-free. It doesn't matter if you never paid taxes on it. The charity gets 100 cents on the dollar. But if you convert that IRA to a Roth, you pay the taxes, potentially hundreds of thousands of dollars. And then the charity still gets 100 cents on the dollar, just in Roth form instead of traditional form. In essence, you've just made a donation to the IRS instead of to the cause that you've actually cared about, which if that's what you meant to do, great, but usually that's not the case. So let me walk you through a bit of a hypothetical example here. Imagine someone with a $2 million IRA. Maybe this is you. And let's just say, you're 68 and you've decided that when you and your spouse pass, about $800,000 of that IRA is going to the church. So in this case, about 40%, right? If you were to convert that $800,000 to Roth over the next half decade, you'd likely pay somewhere around $240,000 in federal and state taxes on those conversions. Obviously, I'm making a few assumptions here, but that's probably about what it would be. Now, that's not accounting for state tax, by the way. If you live in a high state tax state like, say, Maryland, Minnesota, New York, or California, not to pick on a few, but I am, then that's going to be even higher. Now, in this case, the church is going to get $800,000 either way. It's going to be tax-free either way. But in the conversion scenario, you've just sent $240,000 to the IRS instead of having that money compound for the church's own use or for your use during retirement or to go to your children or any other charitable contribution or institution that you might choose. Now, there is a caveat here. If you're leaving IRA money to people, your kids, grandkids, whoever, then Roth conversions might make more sense because they will pay taxes on an inherited traditional IRA. But even then, we need to talk about this from the perspective of the 10-year rule and tax brackets, not just assuming Roth is always better. But for charity, Roth conversions are just lighting money on fire, which brings me to my next point, and this is the big one that you simply do not hear about all that often. Now, before we get to big reason number 3, I want to offer you something. If you're watching this and thinking, okay, but what about my situation? Well, I've created a free 5-minute personalized retirement plan video that I will customize based on your numbers and send to you directly. Just click the link in the description below here, answer a few quick questions about your retirement, and I'll send you a custom video analyzing your specific numbers, your specific situation, no cost, no obligation. It's my offer to my viewers. All right, so now let's talk about reason number 3. And again, this one is critical, particularly if you've recently lost a spouse, or if you're married, chances are one of you is going to go before the other. So pay attention. Reason number 3, not to convert to Roth, you've recently been widowed. Now, this has a little bit of nuance to it, right? Obviously, if you've lost your spouse in the last year or so, I want you to hear this very clearly because you're already in a spot of great suffering. And this is probably about the worst time to do a large Roth conversion. And yet this is exactly when well-meaning advisors often push them the hardest. And here's why it can be so dangerous. You see, when you were married, you filed taxes jointly. Let's just say the 24% tax brackets were where you stood. And for married filing jointly here this past tax year, 2025, that goes up to $383.9K in taxable income. Now, that's a pretty wide bracket. But if your spouse just died and you're going to be filing single this year, that 24% bracket tops out at $191,950. Your tax brackets just got cut essentially in half. Now here's the trap. Everyone tells you to fill up the 24% bracket with conversions. So let's just say in this scenario that you convert $100,000, thinking you're being smart by staying in that 24% bracket. But here's what they're missing. Your income situation has probably dropped significantly too. Chances are you probably lost one Social Security check. If you were both receiving Social Security, you kept the higher of those 2 checks and lost the smaller one. That's oftentimes a loss of $1,500 to $2,500 per month in income, if not more. And if your spouse had a pension, that might have been reduced or possibly even eliminated. So, let's say when you were married, your combined income was $120,000. Now, it might be closer to $75,000. Yes, it's true that your tax bracket may be lower, but it's because your income dropped, meaning fewer dollars to pay those conversion taxes. When you were married, a $100,000 conversion at the 24% rate meant you paid $24,000 plus state taxes, and you were filling up a bracket that made sense for your income level. But now, with your spouse having passed, you're filing single. Your base income is lower. That same $100,000 conversion might actually push you into the 24% bracket when your actual RMDs, required minimum distributions, in the future would only keep you in the 12 or 22% bracket. So let me paint a bit of a hypothetical picture here. Imagine a widow 6 months after her husband tragically passed away. She's 68. By the way, this isn't so hypothetical because it's very close to something that did in fact happen with my practice. This widow's advisor tells her, well, meaningfully, to convert $150,000 per year for the next 5 years to avoid the widow's tax penalty. So let me share a few numbers. She's got Social Security of $32,000. She lost her husband's $24,000 check when he passed away. She has a small pension thanks to some time teaching, $18,000 per year. So for total base income, we're talking about $50,000 per year. Her IRA is $900,000, and her RMDs at age 73 would be about $35,000 per year. Now, if she does nothing rather, her total income in the RMD years is $85,000. As a single filer, that keeps her in the 22% bracket. But if she converts $150,000 now, she bumps up and she's paying taxes at the 24% bracket to avoid future taxes at 22%. And it gets worse because she's converting at exactly the wrong time psychologically, too. She's grieving, she's stressed, she's dealing with 1,000 financial decisions, and now she's being pushed to pay $36,000 in taxes on a conversion that doesn't even make mathematical sense. The widow's tax is real. The fact that tax brackets basically get cut in half when you lose a spouse is a real issue. But the solution isn't to panic and start converting everything immediately after your spouse dies. The solution is to model out your specific income situation now as a single filer and see what tax bracket your RMDs would actually put you in. Now, for many widows and widowers, especially those who lost the high earning spouse, your tax situation may have actually improved. You might have gone from the 24% bracket as a married couple to the 12% bracket as a single filer because your income dropped so much. If that's you, Roth conversions might be the last thing you should be doing right now. All right, so reason number 4 is more technical, but it's a trap that I see people fall into constantly, so we're going to talk about it, and hopefully, if this is you, it's able to save you from this hidden or ghost tax, if you will. So what's reason number 4? Reason number 4 not to convert to Roth is you will trigger Irma or lose ACA subsidies. So, Irma, that just stands for the Income Related Monthly Adjustment Amount for Medicare, and ACA, of course, is the Affordable Care Act. Now, both of these relate to health care, right? And your Roth conversion could trigger Irma surcharges or cost you ACA subsidies. So let me explain both of these. Again, IRMA stands for Income Related Monthly Adjustment Amount and is a surcharge that you pay on Medicare Part B and Part D premiums if your income exceeds certain thresholds. For 2025, if you're married filing jointly, your income exceeds $212,000, you start paying IRMA. That first tier adds about $2,100 per year in additional Medicare costs for a married couple. Now, the problem is that Roth conversions count as income. Yes, they do count as income for IRMA purposes. So let's say you're retired, age 68, with $150,000 in income from Social Security and a pension. You decide to go ahead and convert $100,000 from your traditional IRA over to the Roth. Congratulations! You've just triggered IRMA. Your Medicare premiums are going to go up by $2,100 for the year. But wait, it gets worse. IRMA has a 2-year look back. So that $100,000 conversion you do in 2025, it affects your 2027 Medicare premiums. If you're doing conversions for multiple years, you could be paying IRMA surcharges for multiple years even after you've stopped Roth converting. It's actually not uncommon to rack up $10,000 to $15,000 in additional Medicare costs over the course of a few years if you don't account for IRMA when planning conversions. And as a matter of fact, this is one of the most common traps I see when Roth converting. Another one being not paying the quarterly estimated taxes, which that's a different video, but that is another major Roth trap, right? Now, in any case, this is all money that comes right out of the benefit of the Roth conversion. Now, if you retired early and you're on an ACA marketplace plan, here in Maryland, we have Maryland Healthcare Connection. The ACA subsidy problem can become even worse because those subsidies are based on your income. If you're early retired with low income and getting a heavily subsidized marketplace plan, a Roth conversion can blow up your subsidy. Common scenario I see all the time. You've got a decent sized joint brokerage account, you're in the 0% capital gains tax bracket, and you're drawing money off of that for a few years to bridge a gap, and also getting a heavily subsidized ACA plan while you wait for Medicare. A large Roth conversion can blow that entire scenario out of the water. How about a different scenario? Let's say you're 62, getting a marketplace plan for $400 a month, and you decide to convert 80K to Roth. Your income spikes, your subsidy disappears, and your plan cost jumps to $2,200 a month for the rest of the year. That's $21,600 in additional healthcare costs in 1 year, which will probably wipe out much, if not all, of the benefit of that conversion. Now, the point is this: Roth conversions don't happen in a vacuum, they have ripple effects. And if you're not accounting for Irma, ACA subsidies, and other income based costs, you might be doing more harm than good. Which brings me to my fifth and final reason. And this one is about your most valuable asset. Reason number 5 not to Roth convert: you don't have the time for the conversion to pay off. Now, this is admittedly kind of uncomfortable to talk about, but it's mathematically critical. Roth conversions need time to work. Here's how it works. When you convert $100,000 to Roth and pay $24,000 in taxes, you've created a $24,000 hole that needs to be made up by tax-free growth in the Roth account. If that $100,000 grows to $150,000 over the next 10 years, and you withdraw it tax-free, you've saved taxes on $50,000 worth of growth. Congratulations. Let's just say you're at a 24% tax rate. That's $12,000 in tax savings. But you paid $24,000 up front. You're still down $12,000. The break-even point varies drastically based on your situation, but oftentimes is in the 7 to 12 year time span, depending on growth rates and your tax brackets. You need the money to grow tax-free long enough to make up for the upfront tax hit. But what if you don't have 7 to 12 years or longer? Well, the hard truth is this: if you're over 70, if you have health issues, or you have a family history of shorter lifespans, you need to be very careful with large Roth conversions. Now, I'm not saying don't convert at all, but if you need to model out realistic timelines, this is the time to do so. If you're 75 and your advisor wants you to convert $500,000 over the next 5 years, you need to ask, what is my break-even age? When does this actually start saving me money versus the alternative? And if the answer is age 88 and you have health concerns, that's probably not a good bet. And this gets even more important, mind you, if you're doing conversions for your heirs' benefits. In other words, the beneficiaries who will receive these funds after you. Because of the 10-year rule now, inherited traditional IRAs often get taxed at lower rates than you'd pay on a conversion today, especially if your children can time their distributions strategically over that 10-year period. Not always, but often. This time horizon matters, you see, and if you don't have time, Roth conversions are a gamble, and one where the IRS gets paid first, guaranteed. So look, I'm not anti-Roth. Roth conversions are a powerful tool for the right person in the right situation, and can help you save a lifetime fortune of taxes. But they're not a one-size-fits-all solution, and the way that they're being sold right now in the financial industry is a no-brainer that everyone should do as much as possible, and that anyone who does Roth conversions for their clients is automatically a financial planner. That's not financial planning so much as falsehood advertising. So let's go ahead and recap the 5 reasons that we talked about to think twice before Roth converting. Reason number 1, you're already in a low bracket and probably likely to stay there. Don't pay 22% to avoid 12% in the future tax rate. Number 2, you're leaving money to charity. Charities don't pay taxes, so really you're just enriching the IRS. Number 3, you've recently been widowed. Your tax brackets got cut in half, but so did your income. The math completely changes. Don't convert out of panic. Reason number 4, Irma and ACA subsidies, talking about healthcare. Your conversion triggers thousands in additional costs that could eat into your benefit. And number 5 is if you don't have the time horizon. Conversions, again, often need 7 to 12 years or longer to break even. And if you don't have that runway, you're gambling against the house. The right answer on Roth conversions is it depends. It depends on your bracket, your longevity, your spending, your beneficiaries, your health, and frankly, a dozen other factors. If you're doing conversions or thinking about it, make sure you're modeling out your specific situation, not just following the crowd because everyone says it's smart. And here's how I can help. Remember that free 5-minute personalized retirement video that I mentioned earlier? If you click the link in the description and tell me a little bit about your numbers, your IRA balance, your age, and whether you're considering Roth conversions, I'll create a custom video just for you and send it your way. No cost, no catch, just personalized guidance. I appreciate you watching today. If you found this useful, I would encourage you to share it with someone who might be in a similar situation. In the meantime, I'll see you out there.